Swayam Prabha. Digital India. Educated India.
Welcome to the next session of the course. In the last couple of sessions, we have taken a list of transactions. We have recorded those transactions in the income statement as well as in the balance sheet. We have tried to see the interactions between what do you call it as the income statement and the balance sheet. So you saw that how every transaction is going to impact the balance sheet or the what do you call it as the income statement of a entity out there, and that is exactly what we saw in the last few classes when we recorded the set of transactions out there. So to get this understanding better about what is a balance sheet and what is an income statement, etc., let us solve two small cases, caselets out there. It's from the prescribed textbook. I basically picked up the cases out there. As you can see on the screen, it's a case on Lone Pine Cafe A and Lone Pine Cafe B. Let me start with Lone Pine Cafe A. Let me not even go to Lone Pine Cafe B as of now. Let me start with Lone Pine Cafe A and let us sort of look at working on Lone Pine Cafe A. What is the purpose? The purpose is this will help you understand the concept of balance sheet much better as well as the income statement much better. That is the core idea. In addition to this, I will be doing one more again from the textbook Menard Company A and B. We will sort of do it in the next session or so. As you can read on the case, it says that on March 31st, 2010, the partnership had organized to operate a Lone Pine Cafe was dissolved under unusual circumstances, and in connection with the dissolution, preparation of balance sheet became necessary. So we are asking to prepare the balance sheet. Let's see, read the whole thing. Then there is a whole story out there, and then bottom line, I am going directly to the questions that follows out here, and there are three questions out there. That is, they say that prepare a balance sheet as of November 2nd, 2009. Why November 2nd, 2009? We see this second paragraph out here on the screen out there. It clearly says the partnership was formed by so and so. On November 1st, 2009, each of the partners contributed $16,000 and they did whatever purchase they wanted to make and so on and so forth. So that means November 2nd, November 1st, November 2nd is when the cafe started operating, if you read the case. November 2nd is when the entity called cafe started operating. So they want you to prepare a balance sheet as of November 2nd. That is the list of whatever is owned and owed by the cafe as of November 2nd is what they want you to prepare, and let us sort of prepare that. That is what is the first statement goes on. Second, if I look at prepare a balance sheet as of 30th March 2010. Now, if you look at on 31st March, the partnership decided to wind up operate Lone Pine Cafe was dissolved. So the day before dissolution, end of the day before dissolution, 30th, 31st, it was dissolved. So 31st evening, what was the situation of what you owned and what you owed? The balance sheet they want you to prepare. So let us sort of look at this aspect out here, and then let us try and see if we can answer question number 1 and question number 2. Question number 3 we will come to it a little later. To look at question number 1, what am I doing? I am just taking an Excel sheet out here, and I am just going to prepare what do you call it as the balance sheet out here. The balance sheet as of Lone Pine Cafe as of 2nd November 2009 is what I basically have in mind out here. Balance sheet as of November 2nd, 2009 is what I intend to prepare. That is, what is it? I intend to record all the assets, I intend to record all the liabilities out there and equity out there in the process. That is all what I am going to make. What the cafe owns, what the cafe owes out, as far as cafe is concerned. Now let us go back and start reading the statements out here. The partnership was formed by Mr. and Mrs. Henry Antonio and Mrs. Sandra Landers, who had become acquainted while working in a Portland, Oregon restaurant. On November 1st, 2009, each of the three partners contributed $16,000 in cash to the partnership and agreed to share in the profits proportionally to their contributed capital, that is 1/3 each. The Antonio's contribution represented their savings, and the Landers' proceeds of insurance policy or whatever it is. On the day, also the partnership signed a 1-year lease. The monthly rent for a 1-year lease to the Lone Pine Cafe located in the nearby recreation area. The monthly rent was $1,500. The facility attracted partners as there were living accommodations and so on and so forth. The partners borrowed some money plus $35,000 of the own funds, that is the capital, and they bought all these things aspects out there and so on and so forth. That is basically what it says. Let us sort of try and see if we can start recording from right here. It says that on November 1st, 2009, each of the three partners contributed $16,000 cash to the proprietorship and agreed to share the profit and loss equally in proportion to their capital. When this has happened, what happens to the balance sheet of the Lone Pine Cafe as of 2nd November? Balance sheet of the Lone Pine Cafe out. This is, let us start from, let us not even put second, let us start from 1st November out here. I am going to start from 1st November and eventually take it to 2nd November out there. On 1st November, moment they put it. They say that if you look at the two partners, let me get their names out there. In this particular case, it says Mr. and Mrs. Henry Anthony capital, or I would say capital of Mr. and Mrs. Henry Anthony out. What is the capital contributed by them? They each one contributed $16,000. I can say 16,000 into 2 in this particular case. You want to write it separately, you can write it out. Moment they have contributed capital in the form of cash, what happens? The cafe owes the money back to the partners, that is the owners of the cafe, and on the right hand side you will see cash sitting out there on the asset side of the balance sheet out here, that is to about 32,000. Now I am not finished. Then there is a third partner. I forgot the third partner. I have to add the third partner. Third partner is Mrs. Sandra Landers. She contributes again 16,000. That means what? There is a cash out there becomes out here plus this, that is the cash that is sitting out there in the Lone Pine Cafe as of November 1st when they contributed the capital, and this is how the balance sheet will look like. Of course, I can total this. I have not totaled it. Let me do the totaling of this. Sorry. $48,000 here. I am just going to copy and put out the total in this particular case, and it's 48,000. That is the sources is equal to the utilization. You are not utilized, you have kept it as cash. I move to the next, reading the next paragraph out here from. On the day also the partnership signed a 1-year lease to the Lone Pine Cafe located in a nearby recreation area. The monthly rent of the cafe was 1500. The facility attracted the partners in part because there were living accommodations, etc. about. They have signed a 1-year lease. Has there been a transaction? There is no transaction that has taken place. Monthly rent of 1500, monthly rent of 1500 becomes due only at the end of the month, not at the beginning of the month, unless until otherwise specified out. In this particular case, he says monthly rent of 1500. Yes, at the end of the month, on November 30th, I will worry about paying 1500. As of today, there is only a contract that is signed and there is no transaction that has basically taken place as far as the entity is concerned. So, there will be no impact of this contract on the balance sheet as of November 1st, 2009 of Lone Pine Cafe. Moving further on, the partners borrowed $21,000 from a local bank and used this plus 35,000. Let us worry about this, use this plus 35,000 later. Let us only worry about this. The partners borrowed $21,000 from the bank out. When the partners borrowed $21,000 from the bank, what happened? There is a liability increases, borrowings from the bank is 21,000 out there. When you borrow 21,000 from the bank, then what happens? Your cash balance basically increases in the process out there because you have borrowed more money out there. So, your cash balance becomes 69,000 and that is because you have borrowed, and that is what happens. Now, I go back to the statement out here and it says partners borrowed 21,000 from a local bank and used this, that means used this 21,000 plus 35,000 of the partnership funds to buy out the previous operator of the cafe. Use this plus 35,000. That means what? They have used that is the cash they have used. How much cash they have used? They have used 21,000 what they had borrowed, and then again they have used 35,000 what they have borrowed. This is the amount of money that they have utilized. 35 plus 21, 45, 55, $56,000 is what they have utilized. Out of $69,000, $56,000 they have utilized. Utilized and done what? Let us read the statement again. Utilize the balance sheet is not balanced. Yes, it is not balanced. Let us see, because I have done only one part of the entry and used this to buy the previous operator of the cafe. Of this amount, for that 56,000, 53,200 was for equipment and 2,800 was for the food and beverage then on hand out there. So, that 56,000 was utilized, was given away for the equipment that was there in the cafe, that is 53,200, and then there was also what is called as food and beverage out there on hand, about 2,800 in the process. So, these two 53,200 plus 2,800 is nothing but 56,000. So, $56,000 you have utilized to purchase these two, that is the equipment as well as food and beverage on hand, whatever is there. Now, what happens? Your balance sheet is sitting tight at 69,000 comfortably. That is, when you utilize 56,000, what has happened? The cash balance what you had has come down, and rather the balance has been used for purchasing two assets which we have entered in the balance sheet out there. Now, let us sort of look at it further in this statement out there. The partnership paid 1,428 for local operating license good for 1 year beginning November 1st. The partnership paid 1,428. When you pay 1,428, what happens to your cash balance? Your cash balance reduces by $1,428. And what did you buy? You bought an operating license for that. The operating license is worth 1 full year, it is unutilized. So, operating license. Operating license out there is about 1428 is the value of the operating license. You have paid cash. Yes. And done what? I have bought what is called as operating license. The operating license can be utilized for 1 year, and as of November 1st, effective November 1st, I am not utilized at all. So, when you have not utilized it, it is obviously a beautiful asset sitting for you. And continuing the statement, and paid $1,400 for a new cash register, and paid $1,400 for new cash register. Cash register is a machine and you have paid $1,400. That means what? The cash what you had has gone down by $1,400. What has happened? You have got a cash register. When I have got a cash register, it is obviously an asset for me. I have got a cash register, it is obviously nothing but an asset for me, and that is what has happened. And this is what basically the balance sheet looks like. Now, that is what they say, they want to start the operations on November 2nd. So, November 2nd morning, this is how the balance sheet is going to look like out there, because this is all the money and this is how it has been invested. I am going to read the statement again. The remainder of the 69,000 was deposited in a checking account, that is basically deposited in the bank account out there. So, when the money gets deposited, that means cash goes out there. That means cash goes out. When the cash, basically what happens in this particular case, the cash basically gets out here in this particular case, cash is gone. This 1,172 is gone out there. Rather, it comes and sits 1,172, it comes and sits as a bank, that is, or what do you call it, as a checking account. So, what happens? Your total basically, this is the capital what you had, borrowings this, and use that cash to buy these things, transferred deposited the money in the bank, and this is what it is, and this is how the opening balance sheet basically looks like in the process out there. And of course, the rest of it is a story which you can read through out here. Now, what happens as far as the question is concerned, prepare the balance sheet of Lone Pine Cafe as of November 2nd. Yes, the balance sheet as of November 2nd, 2009 is tight ready out there. Sir, you prepared it as a first. Yes, I prepared it from the first. I prepared it on the first, and whatever on the assets of the first, whatever assets and liabilities on the as of November, end of the day November 1st will become the assets and liabilities on the opening day of November 2nd out there, obviously, and that is how it is. So, this gives you some idea about how a balance sheet, opening balance sheet looks like. When you start a balance sheet, when the balance sheet is there on the opening day, how does it look like? It beautifully gives you an idea. Now, I go to the closing, I go to the next question. Prepare a balance sheet as of 30th March 2010. That is the day the entity has been wound up. The day the entity has been wound up, can you prepare a balance sheet as on that day, on 30th March? Well, we can. What all that we have to do? What? You have to know what is it you own and what is it you owe. What is your asset? What is your liability? That's all. So, let us prepare that. Now, to prepare that, I am just moving out to the other side of my Excel sheet. I am just moving to the other side of my Excel sheet out here. There is no V2, it is as of 30th March 2010. Now, whatever was the capital here, please note all these three things remain as capital out there. Whatever is the capital, all these three things remain as capital out there. The capital does not change unless you have repaid. Sir, they have repaid loan, we will worry about it. We will worry about it as of now. The equipment which is an asset will remain as an equipment which is an asset out there. The food and beverage, bank account, operating license, all these basic things out there will remain as an asset out there, at least as an asset in this particular case, in this year also can remain out there. Only thing is the value of each of these is what I have to decide. The value of each of these is what I have to decide in this particular case out there. Let us see how it transforms, how it is. Let's go back and read the what do you call it as the statement out there. Let's go back and read the statement out here better. Shortly after November 1st, the partners opened the restaurant. Mr. Antonio was the cook and Mrs. Antonio and Landers waited on customers. Mrs. Antonio also ordered the food, beverages and supplies, operated the cash register and was responsible for the checking account out there. The restaurant operated throughout the winter season of 2009 and 2010. 2009 to 2010, I'm sorry, not 2009 and 2010, 2009 to 2010. It was not very successful. On the morning of the 31st of March, Ms. Antonio discovered that Mr. Antonio and Ms. Landers had disappeared. Ms. Landers had taken all her possession and Antonio had left behind most of the clothing, whatever it is. The new cash register and its contents were also missing. Please note, the new cash register and its contents were also missing. No other partnership assets were missing. Mrs. Antonio concluded that the partnership was dissolved. The court subsequently affirmed the partnership to be dissolved on the 30th because 31st morning she discovered and 30th everything was functioning. So 30th everything is dissolved. Ms. Anthony decided to continue operating the cafe, but she felt an accounting has to be done and then called in Donald Simpson, who was knowledgeable about accounting. In response to Simpson's questions, Antonio said that the cash registered are contained $311 and the checking account balance was $1030 out there. That means what? The bank checking account balance was $1030 out there. That obviously is an asset. I have taken it. Now it says cash registered contained $311. Now do you take it as an asset or not? There is a lot of debate about that. First perception is, sir, the register, cash register and the contents have been stolen. When is it stolen? Between 30th and the 31st early morning. So as of, we are preparing what? We are preparing the balance sheet as of 30th March 2010. When you are preparing the balance sheet as of 30th of March 2010, we will record what is it that you owned and what is it that you owed as of 30th of March 2010. In this particular case, the cash and the cash register were very much present on the 30th. It got stolen between the 31st night and 30th night and the 31st early morning. So, as the end of the day 30th, the end of the business day and 30th, the cash and the cash register was very much there. So, we are preparing the balance sheet as of 30th. So, when it is very much there, then I will record that cash as owned by the cafe. Now one can argue, sir, they have taken it and run away. That is fine. But tomorrow you are able to trace the cash and the cash register. Who owns it? It is still owned by the cafe unless until it is written off. Sir, the cash register, I should not. Cash register was 1400. I will keep this cash register also as 1400. Now the confusion is very high, I know that. Cash and cash register have been stolen. Sir, why are you taking it as an asset that is owned? Two arguments. Argument number one, on what date are you preparing the balance sheet? I am preparing the balance sheet as of 30th of March 2010. When I am preparing the balance sheet as of 30th of March 2010, whether the cash and the cash register were present on the 30th of March 2010 at the end of the business day. Answer is yes. It was stolen between 30th night and the 31st morning. I don't know. End of the business day, when I closed shop, when I shut the shop, was the cash and cash register there? Yes. Yes, it was very much there. Given the fact that it was very much there, I will have to record it as an asset as of the 30th of March 2010 itself. Argument number 2. Because the cash and the cash register have been stolen, have I written it off? I have not written it off still, even though on 31st. Supposing you are able to find, supposing the person while running found the cash register too heavy, suppose hypothetically, and dropped it at the end of the street and ran away, and somebody went and found that cash register. Now, to whom does the cash register belong to? Cash register belongs to the cafe. It is owned by the cafe. It is stolen. Stolen is a different activity that has happened, for which I will have to take a legal course of action and so on and so forth. I will do that. But the asset, if found, is owned by whom? Unless until written off. It is not written off as of today. As of the 30th of March, it is not written off. So what happens? The asset is owned by the cafe as of 30th. Sir, supposing I prepare the balance sheet as of 31st, will you take the cash register? I will still take the cash register on 31st also, because the asset is still owned by the cafe. The asset is not written off by the cafe. For example, imagine you buy a brand new car and your car gets stolen, and it gets used for a nefarious activity. Who is the person who is going to be in trouble most? The person who owned the car, because first thing, the automobile is registered on your name. Of course, you can always get out of it saying that the car was stolen, produce the FIR and so on and so forth, everything, whatever is the legal course. But first, the car is owned by you. Supposing the car was stolen and it was found 1 year later, 6 months later. Now, to whom does the car belong? Does the car belong to the police department or the car belongs to you? The car obviously belongs to you because you have still not written off. So, it is registered on your name until unless otherwise you write off. Till such time the ownership is deemed to be with you. So, in this particular case, the until unless otherwise the cash register is written off. It is deemed to be an asset which is owned by the cafe, and yes, it is owned by the cafe. And more importantly is the first argument, on the 30th these things were owned by the cafe. So, it is an asset as of 30th. Now, till the time I write off means I will write off in the income expenditure as an abnormal loss due to theft, whatever it is, till the time I clear it out. It will always be on the balance sheet as an asset for me. Now, to take corollary for this, to take example further, to help you understand further. Today we all talk about banks, NPAs and NPAs. What is NPA? Non-performing asset, everybody can say that. What becomes a non-performing asset? That is, supposing the bank has lent money to somebody, and as per regulations the person who has taken the money has not repaid, is not serviced the loan, not repaid the interest, not paid the principal for a certain period of time as stipulated by the guideline. Then what happens? That is, it becomes what you call it as the NPA. That is, it is an asset receivable for me. I have given loan, bank, I have to receive money, so it is an asset. But it is not performing, so it becomes what is called as NPA. It will still, I know that fellow is not going to repay, that fellow has even died and gone away, or that fellow is absconding, I will never be able to trace him to recover the money. The bank has declared that he is absconding, I am finding it difficult to trace him and recover the money, he is not able to recover the money at all. But still it will remain as an asset in the balance sheet as a non-performing asset out there. But the day bank decides the money that I am supposed to get from that fellow, I will write it off as a loss. It is a loss for me. That is the day I write in the P&L account or the income statement as a loss on account of whatever it is, etc., and wipe it out of the balance sheet. Till such time I do that, till such time I accept, I acknowledge, accept it, and write it off in the income statement as a loss, it will remain in your balance sheet. It will remain as in your balance sheet out there. So, as though you own it. Classic example is the non-performing assets out there. All the money that I have to receive, for example, you said that if it's a bank will recover, various ways they will have to look at what is the collateral and etc., all kinds of things. Imagine there is no collateral and I have to get the money back. I am not getting the money back, that fellow has run away, but I have not written off, so I will keep it in the balance sheet. I know I will never recover from him, but I have not written off, it will still remain in the balance sheet. The day I take a bold decision that I am going to write off, I will write it as an expenditure, abnormal expenditure in an income statement and take it out of the balance sheet. Till such time it will remain in the balance sheet, till such time it is deemed to be owned by you out there. So, that is why the cash and the cash register will still appear in the balance sheet as of 30th of March. 30th of March it was very well there. With you on this? Okay. Now, I move ahead.